It's the middle of February, which means that most of your 2025 tax decisions have already been made, but not all of them. So I wanted to pause and spend some time today talking about a topic that I love. I know it's a little Valentine's Day pun, but I had to do this. So if you are listening to this the week of Valentine's Day when this comes out, happy Valentine's Day from my loved ones to yours. Now let's dive into my favorite topic here on the Wealth Cafe, which is taxes. And it's one of my favorite topics to talk about because I find that so many people, even accountants, tax strategists, whatever it might be, they focus solely on just solving for 1 year. They try to minimize taxes for that 1 year. What deductions can we do? What can we take? Rather than looking at your full picture. So my goal as we are having this conversation is to reduce your tax bill over your lifetime and even the generations after you, rather than just focusing on this 1 year. Because when we do that, a lot of times I will work with clients and we sit down and I notice that they're entering retiring years or they are receiving an inheritance, and all of a sudden they are sitting on a huge tax bombshell just waiting to go off at any moment. So a lot of the strategies we are going to talk about today are generated and geared towards looking at this larger, bigger picture. Now, if that's not for you and you don't want to look at the bigger picture, that's totally fine. This episode probably isn't for you. Now, let's talk about the things that we can't change for the 2025 tax season so we get that out of the way. No, you can't go back in time and all of a sudden harvest capital gains or losses for the year. Those have to be done by December 31st. So something to think about for this year, but for 2025, it's already done. We also can't change things like gifting that happened. Those things need to happen by the end of the year, or if you are somebody who's taking RMDs, those needed to happen before year end. And gifting, or also your equity compensation that was paid out to you, these things needed to be done by the end of the year. However, here are a few things that we can change and still make tweaks to. One of them being if you had an HSA account or you had a high deductible health plan, you can still make contributions to your HSA plan for the previous year. The other thing you may also consider doing is a backdoor Roth contribution. Now, this is for my high earners who may not be able to do a traditional Roth. Keep in mind, in order to do a backdoor Roth, you cannot have any other traditional IRA accounts out there. Now, when you are doing a backdoor Roth, I know we're talking about different tax strategies. This is not going to reduce your taxable income. Once again, we are looking at bigger picture. By doing a backdoor Roth, we are looking at future you down the road. Now, if you earned any 1099 income, you may also be eligible to make SEP IRA contributions. You have up until your tax filing deadline to do those as well. Make sure you're working with your accountant, your bookkeeper to understand what you are eligible to contribute to a SEP IRA. Now, one of the key pieces to preparing for tax season is doing just that. Preparing, making sure you do things like get everything in order. One of the biggest mistakes I see even millionaires do is that they don't have all of their documents in order. They start handing things off to their accountant one-off rather than putting a file folder together and going through and making sure that they have every single document that they need. Now, I want to give you a couple reminders because things may have changed for you from 1 year to another. Make sure, let's say you changed employers. If you have new documentation or you changed mid-year, make sure you have your W-4 and also any retirement contributions you made from both sets of employers to pass off to your accountant. Another thing to keep in mind is if you had a high yield savings account, a lot of people forget that you have to pay taxes on the interest earned, and make sure that you are getting that end of year 1099 statement to show what that interest was to make sure you are accounting for it in your taxes. The other thing to keep in mind is maybe you have also changed brokerage houses or where you are keeping your investments. If this happened in the middle of the year, you may receive 1099s depending on what type of payouts you had, whether it was dividends, capital gains, whatever the situation might be. You may have a 1099 come from both of the facilities that you had your money at. So for example, if you moved from Fidelity to Schwab, one brokerage house to another, you may receive a 1099 from Fidelity and also one from Schwab. So make sure you are passing both off to your accountant or financial team. Another key thing to make sure you are communicating with your accountant is, did you do any Roth conversions this year? And if so, how were the taxes paid, or maybe no tax money was withheld? For those that are 59 and a half, a lot of times you don't withhold taxes because there's a 10% tax penalty on this. So if you didn't withhold any taxes, make sure you're communicating this to your accountant and also where your intention is to pay for that tax burden that you may see coming up. The next thing I want to dive into is any capital gains or losses that you may have and have to account for during this year. Now, once again, you can't change anything and go ahead and go back in time. Unfortunately, we don't have a time machine here and either harvest losses or harvest gains. But what you can do is clearly communicate what you have to your accountant and work with them to see if you have any carry forward losses from previous years. Let's dive into an example. Let's say that in 2023, for some reason, something happened and you have $120,000 in capital losses. And this year, you have $30,000 in gain. Congrats, things turned around this year and it's really looking up. However, you can't sit here and say, you know what, I'm actually going to take a $90,000 loss and try to pair that against other things. There is a max on how much of those losses that you can actually use in a single year. You have a $90,000 carry forward of capital losses and $30,000 in gains. You can offset all of those capital gains this year. Congratulations, it's wiped to zero. However, you can also offset a portion of your ordinary income. Let's say you made $100,000 this year in ordinary income. You can take $3,000 of those losses from previous year and use that against your ordinary income. So to break that down, your $30,000 in capital gains can be wiped away from the previous year, and you can now take your $100,000 in ordinary income, reduce that by $3,000 if you're married filing joint, or $1,500 if you are single. We're going to go with your married filing joint here, and you are now down to $97,000 in ordinary income. The rest of those losses are then carried forward to a future year where you can use different strategies that are applicable in order to help reduce things. One of the final components to think about when you are preparing for tax season is cash flow. Now, it can vary if you're going to be paying a tax bill and you have a tax burden this year, or there's also some strategy to put behind if you are going to be getting a refund. Now, let's start with a tax burden. I hear from a lot of clients of mine, they will sit back and say, you know what, I always get hit with a tax bill this time of year and it really negatively impacts my cash flow. Now, if this is something that you experience, make sure you are setting aside from it now. We have time leading up to when a payment might be due, and especially if you are on extension, you have a longer runway time on when your burden will be due. By setting aside each month, you will then be ready and hopefully avoid any penalties when that tax bill comes around. Another key thing is then to work with your accountant after tax season and figure out what strategies can we use or what changes do we need to make in order to help reduce that tax burden coming up. Now, it may not necessarily be, hey, we want to find more deductions. Is it that we need to set aside monthly or pay estimated quarterly taxes or change what you are withholding on your W-2 to make sure you don't have this giant tax burden coming around every single year? Now, let's say you're on the other side of the coin and you are somebody that receives a tax refund. This is a great time to work with your financial advisor and talk about, number one, how much of that refund are you going to receive? And number two, where can you allocate that money and those funds strategically to work towards your financial goals? Now, it's absolutely fine if you are somebody who is sitting here saying, I want to take a portion of it to spend for fun, I want to invest a portion of it, and I want to have another portion for some shorter term goals. I have some clients who use that money to do things like pay a property tax bill or do repairs around the house. Once again, work with your financial advisor, look at your list of financial goals, and see the different places that you can allocate that money and where it makes the most sense for you and your financial picture. I wish you the best of luck this tax season, and make sure you are always communicating, ask questions, advocate for yourself during this tax season, and I look forward to seeing you on another episode of The Wealth Cafe.